No matter how skeptical somebody might be overall about sustainability, they have to admit that some of those changes are environmental and social in nature. People misunderstand that all of sustainability is impact, and it's not.
Welcome everyone to a new episode of The Blunt Dollar. Today we're joined by Marina Severinovsky, Head of Sustainability North America at Schroders. Marina is a leading expert in sustainable investing, helping some of the largest institutional investors navigate the evolving ESG landscape, integrate sustainability into their strategies, and unlock opportunities in transition investing.
Impact has to happen at the company level, but also at the investor level. So what you have to be able to say is, I've invested in this bank that is making these small loans. And if I hadn't given money, if I hadn't made that investment, they wouldn't be able to do as much as they're doing now with my capital.
What do you think is the biggest misconception about ESG investing today?
We left a gap. We left ourselves vulnerable to somebody criticizing this, especially when underperformance began, and saying,
This is The Blunt Dollar with Ignacio Ramirez. Quick disclaimer, the views and opinions expressed in this podcast are those of the speakers and do not constitute financial investment or legal advice. This content is for informational and educational purposes only and should not be relied upon as a substitute for professional advice. Always do your own research and consult a qualified advisor before making any financial decisions. All investments involve risk, including the potential loss of capital. And now, let's get started with the episode. Welcome everyone to a new episode of The Blunt Dollar. Today we're joined by Marina Severinovsky, Head of Sustainability North America at Schroders. Marina is a leading expert in sustainable investing, helping some of the largest institutional investors navigate the evolving ESG landscape, integrate sustainability into their strategies, and unlock opportunities in transition investing. With a background spanning investment strategy, quantitative equities, and alternatives, Marina brings over 20 years of experience in finance, economics, and consulting. She has seen firsthand how sustainability has evolved from a niche focus to a mainstream investment consideration, and today we'll tap into her insights on where the industry is headed. We'll discuss how institutional investors are adapting to shifting ESG dynamics and why climate and nature risk are becoming central to portfolio construction. Plus, we'll also explore the political and regulatory forces impacting sustainable investing and what investors need to know as they position themselves for the future. If you're an asset manager, an investor looking for long-term trends, or just someone curious about the intersection of finance and sustainability, this episode is packed with insights you won't want to miss. Marina, it's fantastic to have you here. Welcome to the show.
thank you so much for having me.
So before we dig into all of that, can you tell us in a couple of words, what is it that you're doing exactly at Schroders?
Yeah, absolutely. So, as you said, I'm the head of sustainability for the Americas region at Schroders. We are a firm that is based in the UK. We have about $1 trillion under management across
Slight
60
difference.
different, slight difference, $1 trillion and across 60 different asset classes, both public markets and private markets. And one baseline that we have for all of our investment teams is that they integrate considerations of sustainability risk and return, including climate risk, into their work. Now, they can do it all different ways, right? So, somebody working in real estate versus private equity versus public markets may do it differently, but we do want them to consider these things as part of their work. And so, my team and I in the Americas are kind of the conduit, right? The support system for the investors doing that. And then at the same time, we're trying to communicate out to our clients who are looking for perhaps integrated strategies or even strategies that are sustainable in nature. We have about $120 billion of strategies that have a sustainability objective. And then we have about $5 billion of impact strategies as well. So another part of my job is kind of communicating with our investors and understanding what the market's interested in, and really being kind of a spokesperson for our capabilities.
And what led you to specialize in sustainable investing? Did you know, did you wake up one day when you were like 5 years old and you said, "Oh, I wanna do this," or is it something that happened gradually over the years?
It definitely is something that I came to gradually over the years. Although I will tell
Mm.
this story now. I have a daughter who's 10 years old, but a couple of years ago when she was a little bit younger, she was dressing up as like for school, dress as your hero. And she dressed up as me. She put on a little
Oh,
suit or like one of my outfits, and she had like a Schroders branded like bag and like, mug and notebook. And she said, I'm going to work. And she said, because my mom is helping to save climate, save the world, right? Which is very sweet. And then the
oh,
year after, she was going to do it again. And she said, have you resolved climate change or like, have you fixed climate change? And I said, no. And she said, well, if you don't do it by the next year, I'm going to dress as a police officer, So there's like,
pressure.
yeah, pressure taking. So my point is that it has meaning. It's really important, right? As a human being, as a parent, right? You think about the world you want to leave for your kids. But the way that I came to it, I think, is not I didn't go to school studying it. I think there's a lot of young people now who even my old university has, tons of programs now around this, but 20 years ago it didn't. And I think I came in as an investor. I was an investment banker. Went into asset management. I worked in commodities, which is not a particularly friendly, kind of sustainability friendly. Although now, that same team does focus on sustainability as well. Commodities, emerging market bonds, quantitative equities. I was a market strategist, and all at the same firm. So I kind of moved from place to place, and so part of it was I think Schroeder's evolution over time, over the last 15 years, the development of the sustainability kind of investment capability internally. And then part of it was my own interest. And so it was just a great opportunity to move into a place that I think needs investment voices. There has to be a mix of sort of folks who, come from kind of a policy background, right? But then there has to be you have to mix in people who have a real kind of investment background as well, and that's been particularly helpful in the last couple of years to sort of come to these things through really an investment lens.
Yeah. And do you think there was a turning point that made ESG a mainstream investment focus this past decade? Like, what is it that was there a pivotal moment where everyone was like, okay, this is big, this
Yeah.
is happening, and this is here to stay?
It's interesting for you and me, and I guess people listening to kind of think about this history, right? Because my position is that what we do in sustainability, we have always done. So, Schroeder's one thing I'll note is we're all active management, right? We are literally fundamental investors. We are looking at the universe, I mean, let's say on the equity side, looking at stocks, trying to select the ones that we want to invest in for the longer run. We want them to be successful. There is not a single good portfolio manager. If you even went back 40 years before anybody was saying the word sustainability, and you would ask that person, look, do you think about management quality? Do you think about how management is compensated in alignment with their shareholders? Do you think about how they're prioritizing kind of the right things for the business? Do you think about how they're using their capital, if they're investing in things that are going to be productive in the long run, kind of durable for the business? How do they treat their employees? Do they have heightened turnover because they're mistreating employees, underpaying them, losing them to competitors? How are they dealing with their regulators, with their community? Are there any kind of risks building up, right? Let's say around regulation, things that they're not doing well. Nobody would say no to those things. All of
Of
these
course.
things are, again, part and parcel to how we consider investment. I think there was some clever marketing, right? A number of years ago to say like, you put some of those things together and, ESG appears. I think there was a confluence, right, of kind of a situation where energy markets were underperforming and large cap growth type stocks, especially in the US, were outperforming. So, we're talking about discretionary and comms and technology and stocks that generally have a lower carbon footprint. And so they're going to perform different. It's a new economy versus sort of the old economy,
Mhm.
energy, materials, industrials. And so you had this kind of, again, confluence of really good performance for large cap growth and new economy type names that correlated in a way with kind of being more environmentally friendly in their business model, and also kind of having a very highly compensated diverse workforce, and also having pretty good governance, right, and a lot of staff on hand to write policies and respond to questionnaires and get really good ESG ratings. And so that's kind of, I think, how it got very big is when something performs very well, people look for a reason, and this was kind of, it was like a sustainability. But I think again, it was probably much more of kind of market drivers that were doing that. And if you look at market factors like growth, for example, I think there's a lot of explanatory
Mhm.
value there. And I think what people maybe weren't prepared for is the other side of that coin, right? And that started obviously in 2022 when Russia invaded the Ukraine, and oil prices spiked. And all of a sudden, what seemed to be like just forever better performance wasn't. And then people started to sort of have these reservations or ask these questions. I think now that we're here, we've been through that kind of both parts of that experience. It's important moving forward to sort of define what it is that we mean by sustainability. And I certainly have some thoughts on that, so we can talk about it. But
Mhm.
you redefine that, and you sort of say, what is it that we're really investing in? Again, from an investment discipline standpoint, and why do I think it's going to work, and over what time horizon? And really make sure that investors understand what they're buying. I think, like anything else, when there's a bit of a bubble, and there's a lot of excitement and enthusiasm, and everybody seems to be doing it, you sometimes sort of lose a little bit the detail, or
Yeah.
you lose the kind of what you really needed to understand at the core of it. And so this gives us a
Mhm.
good opportunity, I think, moving forward to do that better.
So a couple of things that come to mind. First of all, like I like what you said that these things have always been there. It's just that maybe in the past few years we got better at putting names and words and really explaining what it is. But a lot of sustainability considerations were already in place by investors, despite maybe not having formal frameworks and so on. And I guess also you touched upon the point of marketing. I think we need to talk about this at some point because some people have argued that there's a lot of marketing involved when it comes to sustainability value propositions, and of course the famous words of greenwashing and things like that come to mind.
Yeah.
Um, can you share your view of for those that are a little bit skeptical about sustainable investments and that believe it's pure marketing, what would you tell them? Is greenwashing a real thing or not? And is there real value in sustainable and sustainability aware investments? Let's put it that way.
Yeah. I mean, there's definitely greenwashing. There's impact washing. There's all manner of washing. That's kind of how human beings operate, right? When they see
Mm.
opportunity sometimes. But what I would go back to, right, if somebody's asking the question about the kind of veracity of sustainability investing, right, the validity of it over time, is I would just, again, kind of go through some definitions. You had mentioned that, in the last decade, right, this has become a really big talking point. But obviously, there was always, not always, but many years ago, there have been investors who have invested alongside their own like values, right? So they were investors. I mean, kind of in the old days, right, of sort of SRI, so socially responsible investing, for example. You'd have investors who might be religious institutions or kind of other ethics based investors, right? Who would say there's certain things I can't have in a portfolio. So the exclusionary mindset around saying, I don't want to have tobacco or alcohol or other kind of sin stocks, for example. I have a fundamental problem with these. And I know that I may lose out on some performance. Tobacco stocks can have a very good yield, for example. I may lose out on some performance, but that's okay for me because my objectives here are not just performance, but also, again, reflecting my values and what I do. Those investors still exist, right? We have those
Mhm.
types of, again, mission driven investors or ethics driven investors. We have endowments and foundations and some family wealth, right? And now, you've had something of an evolution into impact investing, right, in that area where there's a range, anything from philanthropy, which is sort of fully, right, kind of not returns focused, to a more sort of alpha driven impact investing that combines, right? We're trying to do well, we're trying to have good alpha by sort of investing in companies that are providing solutions to large social and
Just
economic
one
problems.
comment there, like
Yeah,
for those not familiar with impact investing, what is it
yeah.
exactly?
Yeah, so I will define impact versus sustainability as what a company does versus how a company does it. So, how a company does things is sustainably, right? Or non sustainably. So, you say, how do they, again, what is their governance like? How do they think about environmental, physical and transition risks and climate? Again, how are they doing human capital management within their organization? How they do what they do. But what a company does for a living can be impact. And so if a company, for example, is building affordable housing, right, for, for folks who have lower income, so it's creating, some sort of impact, education, financial inclusion, let's say a company that provides a bank that provides small loans to female entrepreneurs in emerging markets, right, allowing them to sort of get their families onto, kind of into kind of a, better financial situation. So that's what a company does. And impact has to happen at the company level, but also at the investor level. So what you have to be able to say is, I've invested in this bank that is making these small loans. And if I hadn't given money, if I hadn't made that investment, they wouldn't be able to do as much as they're doing now with my capital. So they're having an impact on, let's say, these women or minorities, right? Who are getting these small loans, and it's because I funded this investment that more of these people. And then you have a KPI around how many people have been impacted, right? How
Mhm.
many children have been educated? How many homes have been built? How many people have received loans for small businesses? So it's really measurable. And again, the argument can be, right, that bank that makes these small loans could actually be really profitable because these women do really well and they're very rigorous about repaying their loans. And so it isn't charity, right? Impact investing can very much be making money, right? Profiting and having alpha, from something that is improving both either environment or society. So
So
that's impact.
I have a question about that.
Yeah,
Sorry, because that's a super
sure.
interesting point. I'm curious to hear your answer when people ask you, when you make sustainable investments, are you delivering higher returns or is it similar returns but which are also good for the planet? What's the pitch?
Yeah. On the impact side, we try to deliver market-like returns, right? So you're
Mhm.
not necessarily kind of leaning into like much more alpha. But let's think about it this way. This is kind of my favorite, like recent way to talk about this. That and this is now on impact. So we'll go back to sustainability in a moment, right?
We want
But on
the
impact,
juicy we want
yeah,
the juicy
the,
details, Marina. Bring it
the
on.
the juicy details on the impact side, right? What I think you're saying for impact, if you're going to sort of make alpha out of impact, and we actually have a paper coming out just this coming Monday, like right after this recording is being done, with the Said School of Business at Oxford University. We've written a joint paper on kind of impact and alpha that can be delivered from public markets. So it's because you're identifying companies that not only are thriving in a future of change, but they're actually creating goods and services that help others thrive. And so intuitively, right, those companies should have a tailwind over time, right? They're, because they're providing solutions effectively to kind of again social and economic problems that, society is trying to advance, trying to,
Mhm.
resolve. So again, I think we don't want to overpromise. Our impact portfolios do focus on choosing great companies that are going to be really successful with the business model that they have, and that business model is driven by this need, again, whether it's financial inclusion, education, medicine, whatever it is, right, that needs to be provided that again is going to have a positive impact. But we tend to sort of say it's a combination of the return and the impact, and you're trying to deliver at least a market like return and not give anything up, and at the same time be providing that impact.
So
Going back, oh, sorry, go ahead. Go ahead.
no, I was gonna say if it provides returns similar to the rest of the market, but with a positive impact, why is not everyone doing this? Hey there, quick favor to ask. If you enjoy the blunt dollar, the unfiltered takes, the stories, and the laughs, the easiest way to support the show is by tapping that subscribe button right now while you're listening. And here's my promise. If you do, I'll keep bringing you honest conversations, fresh perspectives, and the kind of finance talk that's engaging, insightful, and worth your time. Thanks so much for being here, and let's keep these great finance conversations going.
Yeah, well, I mean, I think that it's still a fairly nascent space on the sort of public market side, right? So listed markets equity is still quite nascent. We're only just building a capability around it, and so are others. On the private market side, there certainly have been a number of opportunities, in impact. A lot of them have been less than market return driven. They've been like blended finance, where you have, partly is the money's coming from the public sector, right, and then you have kind of private investors coming in as well. So I think it's just the development of that market. And the other thing is you can't guarantee, like you can't with any active investing, right, that you're always going to outperform. And you also have to think about time horizons. A lot of times investors are fairly
Mhm.
short sighted, not all of them, but they're kind of looking for, outperformance every quarter, every year, and that's not something that's sort of feasible to always deliver. So you have to have a sense of what that your sort of theory of change, right, is what drives impact investing, where you say that over time, this is the kind of change that we're going to see. And it may be a multi-year sort of horizon, right, over which somebody has to have a bit of patience to see that value delivered.
Mm.
So I think that's the kind of the broad answer. But as I said, we've been talking a lot about impact, which is exciting to talk about, but it's very small kind of niche still in the area of sustainability. And actually, a lot of times it's good that we're having this conversation because people misunderstand that all of sustainability is impact, and it's not. Right.
Yeah.
If you think about concentric circles, the biggest of the circles is sort of ESG integration or sustainability integration, which is just considering the risks and opportunities and engaging actively with companies. If you think about the next smaller circle within that big concentric circle, it's actually saying, I have some sort of sustainability objective. I would like my portfolio over the next, X number of years to begin to decarbonize, to have a lower carbon footprint, for example. That's my objective, and that's additional to just returns and risk. And then the smallest of the concentric circles, right, in the very, very center is the one we just talked about, which is impact. So not only do I want a portfolio to have a specific objective, but I need it to be really measurable, so that I can actually identify, again, where I've had an impact, where the companies I'm invested in, and where I have had an impact as an investor, right? So that's a very rigorous sort of thing, that impact piece. The biggest of the concentric circles, I would suggest, should be the same size as the broader market.
Okay.
That, anybody who's investing, right, should be thinking about how the world is changing. That's the first thing investors think about, right? What does the future look like? So, what are the changes that are coming? I mean, some of those changes are, of course, political, right? Geopolitical, right? Look, we've just had the tariffs put in place, right? Things change every day. And so investors are always trying to be prepared for that change in portfolios. But some of those changes, no matter how skeptical somebody might be overall about sustainability, they have to admit that some of those changes are environmental and social in nature. We are seeing, climate disasters on a more frequently and at larger scale than ever before. We are seeing, obviously, an impact to insurance coverage around that. There's obviously some regions where there is very little insurance cover to begin with, but in developed markets, insurers sort of processing, right? What does it mean to have this heightened risk?
Hmm.
So, companies are at risk from these environmental disasters. They're also at risk from transition risk, the potential that traditional energy is going to be more expensive going forward. And then they're also at risk from all the regulation, right, from different regions that is trying to shift us, right, over time from molecules to electrons. And then, of course, clean energy is also, just from an economic standpoint, becoming sort of more again economic for buyers. So those changes are environmental, and then there's social change, right? Again, no matter how skeptical you are, you can see that there is demographic shifts. There are migrations, right? Migrations taking place. Some of it related actually to climate. You see aging populations. You see more kind of urbanizing populations, wealthier populations. You see the labor markets shifting, right? So there's definite kind of demographic, social change, and again, regulation around that. What we as a society find acceptable, let's say in terms of labor, right, considerations, human rights, right, in supply chains, or kind of human rights generally globally, right? So like as a company, you're dealing with those changes in the future. So that's what I think sustainability is. I'm going to pause just for a second so it's really, really like clear.
Excellent.
Sustainability is investing in assets that are going to be able to thrive in the future change that happens, instead of being at risk from change or hurt by change. So when I ask a company, do you have a transition plan in terms of your energy use, right, from traditional to renewable? I'm not asking it like, because I believe in renewables, right? Like that's not the point. It's not like a
Hmm.
value system. I'm asking the company, do you have a transition plan? Because if a company doesn't have a transition plan, that presents a risk to them because of cost, right? Those costs are going to go up. It presents a risk to them from a regulatory standpoint. And it presents a risk to them from the perspective of kind of a network effect, because they are no doubt a component of a supply chain for another bigger company that is transitioning. And so if they don't transition over time, the bigger company is going to see that problem in their supply chain and probably replace them with a competitor, right? So I'm asking that question because I'm saying this is the kind of change that's coming. Are you going to thrive in this change, or is this change going to hurt you, disrupt your business? Are you at risk from this change? And I ask the same question, let's say on human capital, right? Are you paying your employees a fair wage? Are you retaining your staff? I'm not asking just because I care about labor. I care. But the reason I'm asking is if the company is in a competitive space where they can't retain talent, then over time that is really going to be a risk to the business. That's why I'm asking. There's change in, let's say, the kind of labor space in your
Mhm.
space. Are you prepared for that change or preparing for that change? Are you going to thrive in that environment and beat out your competitors? Or are you going to be at risk from that change? Are you going to be hurt by that change? So that's it. It's basically investing in companies that are going to be able to tolerate or do well in change. And some of that change, a lot of that change is environmental and social. So all of a sudden it looks different. That sustainability in investing is just the ability to ensure that you are including all of those considerations
Got it.
as an investor alongside the other considerations that you
Mhm.
include, which could be again around market movements and market drivers, geopolitics, all these sorts of things, right? So it's
Okay.
part and parcel.
And at some point, you were talking about time frames. So I'm curious to hear, can you invest sustainability over the short term, or is this inherently a long term kind of investment strategy? Or in other words, could, for example, a short term hedge fund be sustainable, or is that just not possible?
I think it depends on what you're doing, right? As I said, if you define sustainability as this kind of integration, that's the other word, integration of sustainability risks and opportunities, in the short run, let's say that one of the things that you're doing is you're looking for potential controversies and you're trying to avoid controversies, right?
Mhm.
That could be a short term thing. You could controversies can come up on a short run and somebody could be at risk from those. So I think again, it's a question of how we frame it. If you're running let's say it's an emerging markets an equity portfolio, and you're running a very diversified emerging market equities portfolio, and you're an active manager, so you've obviously built a concentrated investment portfolio of stocks in emerging markets, and you've done rigorous analysis of both the regular kind of financial and then these additional right kind of long-term investment considerations, some of which are environmental and social in nature, so you're fully sustainably integrated analysis. Then you invest in those companies and you engage with them, right? So you meet with the companies, you say, look, I've got a 60 stock portfolio. You're one of those stocks. Here's some concerns that I have. Let's talk about how you're preparing for the future, all those things, right?
Yeah.
I think in the short run, that portfolio can outperform the market. There's no reason for it not to. I think what happens if you have a portfolio again that isn't just sustainably integrated, but has some other objectives. So let's say you're doing emerging markets investing, but you want it to be low carbon, right? So you're looking for companies in emerging markets that are either are already kind of low carbon or they are, let's say, providing climate solutions, right? Maybe companies that are actually developing, clean technology in emerging markets. There is going to be a chance that that portfolio underperforms the broader emerging market because there may be obviously sort of cycles where like energy markets are outperforming, and so you underperform. And I think that you just have to make sure that your investors understand that you've introduced a certain kind of bias into the portfolio
Mhm.
that sometimes it may not work, but that you believe in the long run, given the long term trend of decarbonization, is going to work, right? So, those are two really different things kind of delivering a kind of a regular emerging market equity exposure where you feel like you've really done very good fundamental analysis that includes sustainability versus you have are delivering a certain kind of exposure in emerging markets that is thematic in nature, and that theme, even though you believe in it long term, may have peaks and valleys.
Mhm. Okay, that's interesting. So, yeah, uh, clearly a type of investment strategy that really is applicable or at least open to any single investor in some shape or form. Um, I wanna come back to something you said before about impact investing. When you said that a lot of people confuse impact investing with sustainability overall. What do you think is the biggest misconception about ESG investing today? Would that be it, or do you think there are others?
I think that's it. I think that what happened is that we as an industry, as investors, we're not sufficiently clear and distinct about these categories, right? We're integrating sustainability considerations, and then you obviously have two sides to this sort of story, right? You have a backlash that we're aware of in sort of different markets that's political in nature in some cases, it's easy to sort of say that somebody is just taking their values and imposing them on a portfolio. I talked about way back the kind of exclusionary approach where you remove certain things from a portfolio because you don't want to be invested in them on, let's say, ethical grounds. That isn't what we are doing kind of in the modern, understanding, right, of sort of sustainability integration. But because we didn't draw these distinctions, and it was much easier to say, "Don't worry, it's sustainable," and then maybe charge a bit more for it, which again is like definitely not what's going forward. But charge a bit more for it and have like some snazzy and kind of slick marketing. I think that we left a gap, or we left ourselves vulnerable to somebody criticizing this, especially when underperformance began, and
Mhm.
saying, "You see, like they've sold you a bill of goods, right? They said this was always going to work and it's not working, and they've been again promulgating their value system instead of just managing your money and trying to deliver you the best alpha." And so it's really important to decouple. That's why I said at Schroders that all of our AUM, like literally all of our AUM, it looks at the risks and opportunities. That's it. That's all it does. It doesn't mean that they're the drivers of the portfolio. It just means that if a PM is walking away, like he's finished for the day, right? He's turning off his computer, and you say, "Have you considered all of the potential risks and opportunities?" Right here, you're invested in a company that has facilities that are located in coastal areas. Have you thought about, the environmental risks, right, to flooding, let's say?
Mhm.
No, I haven't. I haven't thought about that. Why not? Right? Like, well, because some people don't like that E thing, right? Well, that's ridiculous, right? It's a fundamental risk, so you should be thinking about it. So that's that part. I think, as I said, we consider that to be across our entire business, $1 trillion in assets. That there isn't any asset class that should be sort of exempt from considering all the risks and opportunities. But only 120 billion of a trillion, so it's a little bit over a tenth, right? Has a sustainable objective, and the investors who are coming into those funds understand that that's the objective that they have, that they're trying to achieve something specific. And then about 5 billion, we hope it'll grow, but it's about $5 billion of investment that is impact oriented, where investors not only have a certain objective they're trying to achieve with that money, but they're willing to put a lot of like structure around that, as I said, where you're looking for companies that have measurable change, intentionality around that. Like, it's, I intend this,
Mhm.
my investments are making this additional, it's additionality, additional impact. And these companies are, measurably providing whatever these services are to this many people in this community, et cetera.
Love it.
Again, that is not for everybody. It's out of $1 trillion, it's 5 billion. We hope it grows, but it's a very different approach than this kind of regular PM on any investment desk who just needs to walk away saying, "I have done a full job, a thorough job of understanding the governance, right? How the company is run, how the company deals with, again, sort of the human element of its business, and how the company is addressing the future transition and physical risks of climate for its business." Those two things are really different.
You briefly touched upon the backlash, and I think we should dig a little bit deeper there. So we saw a few years of super rapid growth on the ESG space, and now more recently we've seen increased skepticism, to put it some way. Two questions. One, what is behind all this backlash, in your opinion? And two, do you think this is a necessary reset after some crazy year where everyone and their grandma were talking about ESG all the time? Or is this really a risk for sustainability over the long term, and things are about to change and maybe become less popular as an investment theme?
Yeah. Um, so I think it is a necessary reset. I think, for example, what we're seeing today in Europe, right, where there's been a lot of regulation that's been proposed, and now there's a bit of a reassessment of the cost of some of that regulation to sort of competitiveness in the market. is a necessary conversation, right? That's a conversation that always has to take place between the public sector, the kind of regulatory and policy framework,
Mhm.
and the markets, right? To say the burden of regulation has to be proportionate and has to sort of create good, right? So, I mean, have regulated things like not allowing, child labor. Now there's regulation right around kind of deforestation, for example. Certainly some profits are lost because of it, but clearly society says that these are profits that in the long run would have hurt, right? Globally would have hurt us. And so regulation is appropriate there. And so that dynamic, that discussion, right? I think that there was just again years of enthusiasm, even on the regulatory front, and now there's kind of a bit of a consolidation or a pause taking place where we're sort of reassessing
Mhm.
what is proportionate, what is appropriate. From an investment perspective on the backlash, so we didn't say it, but I came into the role in 2022. The first thing that I did when I sort of came into my current role is I wrote a paper that's called ESG through a US lens. And I talked about some of what I saw as concerns. And this is before Russia invaded the Ukraine. So they hadn't manifested yet. You didn't have the backlash yet politically. It was kind of the very beginning of the year, 2022. And one of the concerns that I saw was that we needed to address folks who were hesitant, right, about transitions, about change, with more respect and empathy. So change is very difficult. When you say it's inevitable that we're decarbonizing our economies, that is true, but that hurts someone, right?
Mhm.
There's going to be somebody who works in the fossil fuel industry. There are communities reliant on coal, reliant on oil, state like tax revenues, right? They're reliant on those industries. Um, you just have to be empathetic. You have to be respectful of the fact that change, even if you're right, you're pointing out that change is going to happen and you have to be prepared for it, that change is difficult and it can be financially difficult in the short run for folks. And that, like not everybody's comfortable with change. And so if you sort of don't account for that, if you don't acknowledge that, then you build up people around you who may be quite resentful.
Mhm.
And you've been successful, right? What you're doing, the investment side is performing really well. And so you keep saying this, and they can't really touch you because the performance is so good. But when the performance turns, as inevitably it does, and it did, right, because of market cycles, then the people who were resentful have every opportunity to point out that you were wrong the whole time and that the whole time you were really kind of disrespectful and not empathetic to kind of their concerns. That's, I think, where we are. And I think we'd be smart to avoid that going forward and to have conversations. We talk now about just transition. How can we affect a transition that does take into consideration the folks who lose from that transition? You're talking about reskilling, training, finding kind of new avenues for work. I mean, all those sorts of things for people, employees, community, right? So I think just a different approach to it's maybe, yes, maybe these environmental and social changes are inevitable, but that doesn't mean that they're painless, and it doesn't mean that we should discount, again, that kind of respect and empathy. And I said a number of other things in that paper too, but that was the big one. And I think that ultimately is what has fed a lot of the certainly political backlash, right? I think that we also need to sort of again understand as investors we need to sort of articulate over and over again that we want companies to be
Mm.
successful, we want them to successfully transition, we're investing in companies because we want them to succeed, right? And so when we engage with companies and we ask them sometimes the tough questions, right, about their climate transition or about their, again, their human capital practices, the reason we're asking, sometimes it's like a little bit of tough love. You're a critical friend, but you're a friend still. You're asking because you want them to be thinking about these things and to succeed in the future. And so some of the backlash has been on the kind of basis of like the politicians saying we're going to defend the company from its own shareholders, right? That dynamic, that tension between the company and the shareholders is really unfortunate. And so I think, part of that is kind of incumbent on the shareholders and the company, to have a better way to come together, but to articulate that we have the interests of the company at heart, right? That as a shareholder, you want it to be successful. And so Schroders has done a lot, I would say, on the active ownership front. It's also called stewardship or engagement to really kind of send that message, right? That we come to the table with this sort of spirit of we want to see you succeed. And when we're engaging, for example, with large fossil fuel companies, right? Companies that currently, produce oil and gas. We are very conscious that many of these companies are going to be the source of success for decarbonization. Many of them are investing heavily their future capex right into hydrogen, green hydrogen, into battery storage, right, into renewables. They have the money, they have the resources, they have the technical know-how. They're absolutely part of a global solution and not like a problem that you have to set aside or sort of right. So that I think these kinds of messages are really important. To ensure that you don't have this vacuum that you create, right, where the like a political message can then develop that either companies need to be protected from their own shareholders, or that money managers are sort of taking the beneficiary, right, the kind of money of the investee, the end investor, and using it for some goal other than what is best for that investor, right? We don't want those narratives to have sort of fuel.
Mhm.
And that's why we have to explain ourselves better. That ultimately what we're doing is what's best for the client. That's our objective. And so for most of our clients, we're delivering, again, sort of we're looking to deliver, I have to be careful, great long-term returns. And that includes assessing risk and opportunity around sustainability as well. There's a subset of our clients, as I said, who have come to us specifically for sustainable objectives, impact objectives. We are delivering to those clients what they have asked for,
Mhm.
right, as well as we possibly can. But what we're not doing, right, is we're not sort of using someone else's capital to promulgate our value system or kind of what we believe in. And I think that, like I said, that narrative in the market, it doesn't come from nowhere. It comes from that sort of resentful place, right, where there were years where the asset management community, I think, was not sufficiently empathetic to the fact that change is difficult, that it's like push and pull, that it's like stop and start, right? Two steps forward, one step back, those sorts of things. And that you have to account, right, for people who are damaged by change. And you have to think about them too.
Mhm. I want to take a step back now and look at ESG, but from the data point of view. Um, so there's something called the ratings, the ESG ratings, and there's been, of course, huge providers that have emerged over the past few years, and on which investors have relied to make their investment decisions. But the problem is that these ratings diverge sometimes from one provider to another. So why do you think these ratings are so inconsistent between one provider to another? What's the issue here? Hey there, quick ad break. Do you work in the finance industry and have a genuinely interesting story to share? I'm always on the hunt for great guests who bring raw, unfiltered insights to the table. Or maybe you know someone with a story worth telling? Please put us in touch. You can reach out to me directly via LinkedIn. I'd love to hear from you. And now, back to the show.
Yeah. I think, and I want to be careful because I have friends, at MSCI and Bloomberg and all these places, right? So, but
Mhm.
I think that to the end of the day, they are measuring sometimes different things, right? A lot of it is a bit black box because you don't know exactly what the model is underneath and how things are weighted. You're right. The correlations between sort of different, companies and their ratings are fairly low, like something you wouldn't tolerate, let's say in credit ratings, right? Here you see that. And it's been a fairly unregulated space. That is changing. I would say the regulators are looking at the rating agencies, and trying to sort of come to some more formality, right, about what it is that they're doing and providing, especially since they become so important, to so many investors' perception of the market, right, where they're looking for that sort of score, the number of globes, right, the number of
Mhm.
stars. I think that we have, as an investor, just approached it from proprietary analysis perspective. We do look at ratings because we want to know kind of how our clients might perceive a fund, and just to compare a little bit. But at the end of the day, we are doing our own analysis. We have proprietary models that are measuring the things that we think are material, the things that we think we can put a price on. So we do one model where we have kind of externalities that are created by businesses. So there might be environmental or kind of social externalities. So you can think about tobacco as an easy one. Produces disease, right? Disease is costly. who's paying for that disease, right? Who's paying for those illnesses? And does society say to the tobacco company, and of course society has said to the tobacco company, you're going to pay for these diseases, right? We're going to sue you, or we're going to regulate you. There's going to be new legislation, and you're going to be responsible. And you can think about something similar for an alcohol company, for a sugar company, like a food and beverage, obesity. Like, what's the cost of obesity to society? And should the companies that are basically driving, through sugar, more obesity and more heart disease and all those things be responsible for that? So that's one way that we measure kind of risk to companies is, are there negative externalities? And of course, some of them are environmental, right? So carbon. And what would the cost of that externality be to a company? Then we look at stakeholder mapping. We look at thematic alignment. We have lots of different ways to sort of measure risk in a portfolio and opportunity in a portfolio, and we do it ourselves. We have over a dozen different tools that we've spent over a decade building because of this reason, kind of what you're saying, right? Is that if you're just looking at the rating, you have to do quite a lot of work under the hood, which is usually not available to you, right? In terms of kind of the data underneath to understand what it is that's being rated. Ratings are also very backward looking. And the thing about, I think I keep saying the word change. Change is the most important thing for investors, right? So the thing about sort of a company that, let's say, may have had a controversy or may have, had some negatives, right? Is it may be changing and improving, right, on that front. So we look at sort of the trajectory of improvement, and a lot of times the ratings are going to be backward looking, and they're not going to be adjusted sort of in real time. And so you may have some poor ratings for companies that actually are some of the less risky ones because they've gone through a bad period and they have made changes that are going to make them sort of more durable. So I think there's, yeah, and it's the lack of transparency and the
Mhm.
kind of backward looking nature of it, and the fact that everybody has a slightly different model because that's what they've decided is kind of the appropriate thing, but that's what they've decided, right? And so as active managers, as fundamental investors, we've taken the approach of saying we'll
Yeah.
take raw data. We love to have raw data from companies themselves, but sometimes you need to have sort of estimated data, and you can get that from some of the big
Mm.
providers. So we'll take the data, but then ultimately we want to decide how we assess, risk and opportunity. And by the way, we show that to our clients. We have papers around our own methodology. We actually open the black box. We say this is exactly how we do it, because we want our clients to be comfortable that they agree. And if they don't agree, that we can have a debate around it. But this is how, and even then, we don't use a single score. We think of it as an input into a broader analysis, right? It's just a way to understand what risk you may have and also to engage with companies around it. That's the other thing I would say is I think, if somebody is using the rating, but they're kind of taking it with a bit of a grain of salt, it's a directional indicator,
Yeah.
let's say. And then it's a way to sort of say, okay, maybe there's something that I should red flag, or maybe there's something that I should discuss with the company. That's, I think, fine. I think
Mhm.
it's just when you take any one number, whether it's the third party number, right, from one of the rating agencies, or whether it's our sort of number. If you take a single number without a grain of salt and as
Yeah.
gospel, that's when I think you get in trouble.
Yeah, 100%. No, and I think maybe it's not necessarily a bad thing, right, to have these different ratings because they may put the spotlight on different things, and by combining them, you get a more comprehensive picture. Another question that looks at ESG top down, unrelated topic. So I think it's undeniable that the finance industry has been pretty male dominated for centuries, unfortunately. Uh, but sustainable finance, I think it's my impression, is one of the few areas in the finance industry today where women hold a significant amount of leadership positions, and it's less male dominated, to put it some way. And I'd like to ask you: is that only an impression or not? And if not, and if that's the case, do you think women are really at the forefront of ESG investing more in other parts of the finance industry, or not at all?
Um, it's kind of a dangerous question, I think. Not like I don't mean to be like negative, but it's an interesting one. There's been I mean, I guess I'll say it, right? Like sometimes people talk about like a pink ghetto, the pink ghetto, right? Where you sort of have women in kind of more senior leadership, but they're not like, they're not in roles that are as decision making roles, or they're not as like influential roles, right? Where you sort of the CEO will be male, and the like CIO will be male, and the COO will be all the kind of like, like those drivers. And then you'll have like somebody in a role like the head of sustainability, right, which doesn't report to the board, for example, doesn't have as much sort of influence, and it's almost like here's kind of like a little treat, right, and then you have that kind of tokenization. I think there's some element of that. What I don't like, honestly, is if we still look at the numbers on the investment side, like the number of female portfolio managers driving investment decisions,
Hmm.
you're still lacking those numbers of women, right? Again, it's hard to just like focus specifically on gender, but there are definitely a lot more women in corporate sustainability, right? So, like the corporates themselves, decarbonization and kind of other goals that they have. And again, I think what's really important is to look at how those roles are integrated within their organizations. Again, is it a board level reporting? Do they have the real kind of budgetary decision making? Like what is the kind of influence of that role, or is it just sort of virtue signaling or kind of like a figurehead type role? On the financial side, I mean, I think you're right. I think women have gravitated towards sustainability. Part of that because it does align with women's values. I mean, I don't know. Again, men are parents too, but like parents, for example, will think about the world they're leaving their children in the future. Like, I think we're human beings. We're driven by some of our sort of own, like value systems, and you want to find meaning in the work that you do. So that's how I feel, and others feel, I'm sure. And so you do see a lot of women, I think, also in engagement and stewardship type roles, right? That engagement with companies. And again, you have to think about whether that is sort of happening over here in a corner or if it's happening in a real way, like from an investment engagement standpoint. So at Schroders, we're very lucky we built the system in a very investor focused way. So almost all of our engagements take place with the investment team included, and the majority of them actually are led by the investment team. They're
Hmm.
driven by the investors, and that's what companies prefer too. They want to be at the table with the portfolio managers who actually own their assets, right, and understand their business really well. So I think it's a mixed bag. I think for every role you kind of have to ask, what is is it an influential role or is it sort of a performative, situation for a company to put a kind of a female, person in that space and kind of say, look at this, right? It goes back to the kind of greenwashing or kind of slick marketing sort of question too. It's like there's some diversity washing, I would say, in all industries, and this is kind of no exception. So again, maybe it's not the kind of answer that you want, but that's kind of my perception of it. I think that what you want is really embedding these decisions in a real way in the investment decisions and have them be influential decisions and respected types of
Hmm.
decisions. And that's where you have more women in those roles, and I'm hugely celebrating that. You know.
And how can we do just that? How can we bring more diversity into finance, in your opinion? What's the key?
Goodness. I mean, that's a really big one, right? I mean, I think that, educational achievement, right, for women is certainly on the rise. Women are gaining the degrees, they're coming into the entry level roles in finance as everywhere else. I think finance from kind of we have to market ourselves a little bit better sometimes. Young women can be put off, from finance because they don't understand that there's many different roles available, some technical, some less technical, right? I think that obviously education system for kind of STEM, right? Or STEAM, but more science and math and technical education, kind of geared at women
Hmm.
has been, I think, succeeding. And so you want to send that message, right? That there's these opportunities available to women. I think that, like I said, at the starting place, right, early in the career, you do have a lot more gender parity, and then over time you lose women from the industry because you're not sort of creating like as their life cycle continues, I think enough flexibility for them to be able to build their lives, their families, and also to kind of build their careers. Unfortunately, I think it's still the case. So Schroders is actually, as a house, is incredibly focused on inclusiveness. It's been focused on flexibility. We have a flexible working charter. And we've increased both maternal and paternal leave and family leave in general, and have tried to work really hard to again retain those talented women that we have from the beginning and to kind of, give them role models and mentors and sort of, make sure they're growing through the organization. And it's hard work. I mean, we're definitely at over 40%, I think, now, in terms of women in fairly senior roles, and then kind of well over 30% in some of the kind of key roles across the organization being women. We actually just published our last sort of diversity, annual reporting in the UK. Um, but it's, yeah, it's no small thing, to be able to kind of evolve the industry to support women over time. And that goes, I think, for all diversity. Again, we focus on diversity of thought, diversity of background, having really kind of teams at the table that kind of look different, think different from one another, are kind of going to make better broad
Mhm.
decisions because they're not all sort of thinking in one way. And gender is just one, kind of one part of that, or sort of one of the dynamics within that. But yeah, I think it's seeing role models, right? It's seeing other women who have kind of made it through to senior roles. How did they achieve that? And then having organizations that provide that kind of flexibility and
Yeah,
support to do that. So I think it's like easy to do the recruiting, right? But it's much harder to do this sort of
yeah,
long term work of retention. And by the way, like, if I can bring it back to sustainability, when we're looking at companies, our investee companies, these are the kinds of questions that you would ask them
you
too.
look at.
And
Yeah.
you would tie it back to financial materiality, right? The
Mhm.
companies who can do this successfully and retain these talented people are going to succeed better over time. So as an investor, you have an interest in that.
And going back to woman, so you clearly made it to the eyes of many of us, heading a sustainability offering of a huge asset manager. If you could give one piece of advice, particularly to women entering the finance industry today, to go as far as you did, what would it be?
Yeah. I think you have to build like an incredible sort of support system around you. I mean, I think that that's when I was in business school and I was doing my MBA. I heard this from a CEO, a female CEO came to speak to us, and she said, like the most important decision you're going to make probably is the partner that you choose in your life,
Mm,
right? Your spouse, your partner, making sure that you guys are sort of, sharing the burden of the sort of domestic work. It's also a joy, domestic work, but it's obviously also the responsibility. So building, I think, that support system, right, for yourself and thinking in that kind of long term way, like, how am I going to go through the cycles of my life? Sheryl Sandberg years ago talked about the kind of lean in concept, right? When you start early in your career, like hit hard, because at that point you don't have a lot of the additional responsibilities. And so this is your moment. I mean, I was an investment banker. I worked ridiculous hours, and like, you put in a lot of work to kind of build your foundation. And then you hope that you built yourself the kind of foundation that when you're kind of in that middle phase of your career where you need some more flexibility and more support around you from both your organization and your family, again, your kind of village, right? That you can lean on that. And then
yeah.
as your kids get older, and not everybody has kids, some people have other obligations to take care of their parents or kind of whatever it is they need to do in their life, right? As your kids get older, for example, you obviously have less of that responsibility. And so you can lean back in again. So you can have a second or third sort of life to your career. And that's, I think, another really good piece of advice that I've heard is that you have much more time than you feel you do. I think when you're in your early 20s, everything seems like it's like, it's very like there's not that long a runway, right? It's like everything has to happen right now. But the reality is the careers are long. They span decades. They span all these sort of different life, like sort of stages. And so just to kind of think long term, it's a marathon, right? To think about it that way. But again, to choose the right team for your marathon to support you, because there inevitably will be very tough times on the marathon. I think, finance, as I said, I mean, to me, it's a really exciting sort of industry to work in for women. It's obviously lucrative. It's, can be high profile. It's, great sort of problem solving and challenges and intellectually rigorous, all those things. If you're a commercial person who enjoys kind of being with clients, there's roles for that. If you're a very technical, quantitative person who enjoys the analytical side, there's roles for that. I mean, it's a really broad industry that allows for many different skill sets. And then one thing that people quite love about it is like the way that it's judged. If you're a portfolio manager, you're judged on your performance, not on what you look like or your gender or anything else. It's like very
Yeah.
black and white. It's like, what do you deliver? Deliver. And that's actually great, I think, for women. So I think it's that
Yeah.
initial hurdle of sort of demystifying the industry and kind of making women feel more welcome into it. And then again, supporting them as you
Mhm.
go. But again, for me, I would say that advice is to like hit hard in the beginning, really, really work hard. and then think about that kind of long-term journey and who's there to support you on your long-term journey because you won't be able to do it alone.
And maybe for professionals looking to build a career in ESG investing beyond just women, but anyone thinking about entering the industry, apart from that support system you were alluding to and working hard, what skills do you think they should be focusing on in order to be successful in the field in the next 5, 10, 20 years down the road?
So again, sustainability is such a broad brush, right? That we have to kind of remind ourselves you're talking about finance, you're talking about sustainability in financial services, because there's also kind of, again, corporate sustainability. That's the operational side. Like, if you're working for one of the corporations and you're, like sort of working on their sustainability objectives. But if you're doing finance, I think the number one thing is to be at heart a person who understands the markets. I think we have had some of those challenges in recent years where the industry grew so quickly that we didn't have enough people who sort of knew the markets and were kind of investment oriented. And so other people entered the industry too from kind of more non-financial backgrounds, which is fine and people can learn. And that's what I would encourage you do if you come into that role. But if you are coming in new into banking or asset management or wealth management or whatever, I would think about those fundamentals first, the fundamentals of the market, right? And understanding the investment sort of discipline, the investment rigor, right? The investment theses. At the end of the day, it is not our job in the financial sector to solve climate change as a challenge or natural capital biodiversity degradation or human rights violations. That is not our remit. We're not there to solve those problems unless we're working in impact investing, right? And then, you're investing companies that are working on solving those problems. But in general, in finance, it is not your job to solve that problem. What your job is to understand the risks that those challenges present to your clients' portfolios. And those risks manifest, right? They crystallize through financial channels, right? So it's like, what is going to be the financial impact to the portfolio again that comes from a regulatory, changes or demand, right? Changing demand for goods and services, right? So it's always that kind of translation,
Mhm.
right? Into again, those kind of that crystallization of those costs or opportunities. So I think starting with the investment predicate, right? Being an investor first or someone who understands the investment side first is really important, regardless of the kind of investing you end up working in, right? So
Yep.
you may end up working in value or growth or, different asset classes, right? Oh, and sustainability, right? Different, as we said, forms of sustainability and impact. But the fundamental underneath has to be, I think, understanding capital markets, understanding the investment side, and then you build onto that whatever your
Yep.
specialty is.
Yeah, I like that building on building some solid fundamentals, and in order to do that, something that comes to mind, of course, is certificates and studying things like the CFA.
Oh,
Which
yes.
I had to bring up at some point because the reason why Marina and I are talking today is because the CFA Institute kindly made the introduction. We're both going to be assisting the CFA Institute live in Chicago from the 4th to the 7th of May. Marina is going to be one of the panelists in one of the panels that is going to focus on sustainability. I will 100% make sure to attend that one because I think it's going to be a really, really good one. There's going to be over 1,200 finance professionals, and we're going to be talking about some of the major topics shaping the finance industry today. So, if you're curious about financial markets and enjoy meeting other people and networking, make sure you come to this event because it's going to be absolutely fantastic. Marina, it's been also absolutely fantastic to have you on this show. For those of us that want to learn more about you and your work and maybe the latest ESG trends, where's the best place we can follow you?
Oh, okay. I mean, I have a pretty live sort of feed on LinkedIn where I sort of talk about all the places where I'll be, and I do present quite a lot around the country. The CFA event, to your point, Ignacio, what's really great is the panel that I'm moderating has three CIOs on it, like not like sustainability folks, but CIOs, the chief investment officers of their organizations. And so we're going to be talking about integration of sustainability from the perspective of that person, right? Who's, again, not a sustainability specialist, but an investment specialist. And then I'm also teaching a 90-minute workshop on biodiversity and natural capital and how to sort of measure risk around that to portfolios. So kind of two very different things. So yeah, so LinkedIn is a place where I sort of share where I'm going to be. I also, as I mentioned, there was the initial paper that I wrote that was called ESG through a U.S. lens, which for those of us sitting in the U.S., I think that's a good place to revisit, right? Like, what are we how are we rebuilding, sort of sustainability investing here in this market going forward. And then the other thing that I do every year is I do write an outlook piece,
Mhm.
and so it's sort of my 2025 outlook. They're pretty brief, but it's 8 key themes to focus on for 2025, and that's an annual piece that I do. So that's another spot that you can take a look at, and it reflects a lot of our firm's views and areas of focus every year. And so that's a good digest, I would say. It talks in this case about some things like private markets. It talks about sort of looking at climate transition investing as an opportunity rather than sort of a cost. So a lot
Mhm.
of those sort of trends that I really see as nascent thematic investing, sort of choosing sustainable themes that are really lucrative. So I have eight good sort of themes for 2025 that I think that I hope are going to play out.
Yeah, I think a lot of the things we talked about today are definitely in that outlook. So make sure you check it out. It's available on their website. If you Google it out, you'll find it very, very easily. And Marina, it's been an incredibly insightful conversation. Thank you so much for sharing your expertise, your unique takes on ESG and sustainability in general. I am very much looking forward to meeting you soon in Chicago, and I hope 2025 is the year where sustainability keeps growing and becomes top of mind for most, if not all, of the investors out there.
Thank you so much.
The Blunt Dollar is written, produced, hosted, and edited by me, Ignacio Ramirez. Everything you hear, concept, script, sound design, and production, comes straight from my desk, and occasionally my kitchen table. Thank you so much for listening, and join me in the next episode of The Blunt Dollar for more raw, honest finance conversations.